A very special guest, Adrian Mowat, emerging market equity strategist, joins us on the show right now. Adrian, hi, morning. The big news this morning is Xi Jinping's commentary coming in. Would you say that fears of a trade war, and a full-blown one at that, are completely behind us? Because it seems like this is true stalling both by Xi Jinping as well as Trump.
Look, I think it would be too early to say that what Xi Jinping said today at the Doha conference is the end of a trade war. His public speeches have been very pro-globalization, anti-trade war. So there was nothing new in the speech, nor was there any sort of new statement about sectors that were going to open up, because the statements on aviation, on the auto industry, on the finance industry have been made previously. So I think the market is still going to be in an environment where trade conflict generates volatility, but the volatility will be driven by statements from the White House as opposed to statements from the Chinese leadership.
Right. There seems to be a lot of excitement in India with the auto names in the aviation sector, as China is paving the way, Adrian, for perhaps regulations being done away with, especially in those two spaces. Does this open the window of opportunity for trade across the region?
Well, remember that we've got some conflicting signals here at the moment. So China has been suggesting that it will allow foreigners to own more than 50% of auto companies rather than moving into China via joint ventures as they have done. So that's the liberalization. There is also significant talk around tariffs for the auto industry, particularly tariffs against electric vehicle manufacturers from the U.S., perhaps trying to protect the Chinese. So again, I think the detail here is much more conflicted than a clear message of opportunities arising. Now, you might want to push this a bit and say, look, if China takes the route of globalization, the U.S. is still fixated on its current account deficit, its trade deficit, then you could get some greater cooperation of other nations trying to defy what the U.S. is doing. But again, it's not in the detail. We have to remember that what markets are really struggling with here is incoherent policy. You have an administration that announced a large tax cut at the beginning of the year, a big fiscal deficit. We're talking about a budget deficit of possibly even $1 trillion. If you run a budget deficit as a savings deficit by the public sector, it will cause a bigger current account deficit. It will compound your trade problems. And if Trump is really fixated on reducing the trade deficit, then it's very hard to understand how that is possible with their fiscal stance.
No, that indeed is the case. Okay, so having established that, Adrian, let's talk about India. Let's talk about all that's brewing in the market here. The banking sector issues are pretty much now well documented. In the very latest move, in a specific bank's case, Axis Bank, the term of the CEO has been curtailed, which has just sent out a signal that, somewhere change is very much in the works. Through this leadership transition, as you see it, and perhaps you can get in your global experience, is there an opportunity to look at some of these names? Because people influence culture, and if the leadership changes, and that just ignites a new way of looking at things, a new perspective, perhaps?
Well, I think the specific story around Axis Bank is very new, isn't it? So the board of directors are not allowing the current CEO to continue for the end of her term. I think it is too early to suggest that this is a buy signal. And if you go back to the global financial crisis, and if you remember some of the issues around companies such as Barclays and trying to find a new chief executive, these things can take a while. You will notice that Deutsche Bank had management changes over the weekend with some clear conflict between their advisory board and the CEO. I think it's dangerous to assume that you've got to the final episode of the soap opera. You'd be better off to see who the new individual is and hear what their proposals are, and then make an assessment at that point. I think as you look at the charts for this year for the banking sector, the safe approach has been to stick with higher quality private sector banks. I think one of the more interesting news stories today in India is that HDFC have started to push up interest rates. And so we're moving against what's been a very, very favorable trend of declining rates for the last 5 years. Now, this may be good news in terms of net interest margins, and it may reflect a reasonably robust Indian economy, but we need to sort of think about the consequences of a change in direction for consumer interest rates.
Adrian, the Indian banking sector per se now has clearly been mounted on the Indian retail sector growth. Now, as of now, the retail growth is strong, retail sector is growing, but do you think it's a matter of time that retail-dominated banks could also face the heat of slowdown? Because, even the retail business has to go through a peak and tough cycle.
Yes, although I think, the extremes of the credit cycle that you see in the corporate sector don't typically occur in the individual retail sector, where mortgage lending tends to be the dominant form of lending. Then you would have lending for the auto sector, credit cards. They tend to be a lot smoother. And when you have a more meaningful sort of negative credit cycle, it's typically driven by the employment cycle. And I think at the moment it's too early to make that sort of call in India. I made an earlier comment about slightly higher rates at HDFC, but that's very much the start of cycle. It will be towards the end of the interest rate increase cycle that you would expect to see some struggling consumers.
Adrian, would have loved to talk longer, but got to let you go on that note. Thanks so much for taking the time and chatting with us today.